for March of 2019 market commentary. My name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this segment is dedicated to keeping you informed about what's going on in the current market environment. Risk assets performed well in the first quarter of 2019. The most aggressive stocks sped higher as the fourth quarter growth panic and tax loss selling abated. And what this chart shows is the asset class returns for the first quarter of this year. And the S&P 500, which is a measure of the performance of domestic large cap stocks, the yellow bar there, ended the quarter up 13.65% for its strongest quarterly advance in a decade. Small cap stocks, as measured by the Russell 2000 index, were up even more with return of 14.58%. And similarly, international stocks also performed well, with the MSCI ACWI ex-US index, the gray bar there, up 10.31%. Bonds and commodities also had positive absolute returns for the quarter. While this rise was very welcome, we have seen a pause over the last few weeks. This chart shows the Russell 2000 index, again a measure of the performance of small cap stocks. And what you can see here is that small caps lost ground in the month of March, really because bond yields rushed lower and global growth remained a source of concerns. And in small caps, even with a huge rally year to date, we're still well below the highs established in September 2018 and below a key resistance level, that yellow line there. It's a slightly better but similar story for large cap stocks. If you look at this chart of the S&P 500 index, which again is a measure of the performance of large cap stocks, you can see that we've had a huge rally since the market had a bottom in December of 2018, but we've not yet cleared the high established in September 2018, and we are now about back to where we were in February of 2018, which is what that yellow bar shows there. So while we've had a great start to the year and a very nice rebound from the losses experienced in the fourth quarter, the market is still essentially flat over the last 12 months, and we've seen a lot of sideways movement, which can be very difficult for some types of investment strategies, such as trend following strategies. So why did the markets pause a bit in March? Well, first, there's been a lingering concern over global growth, and towards the end of March, we received a signal from one of the most closely watched predictors of recessions. This signal lies within the bond market, and the bond market really shows us how confident investors are about the economy because it shows their level of demand for U.S. government bonds. And there was concern in March that a recession may be on the forefront. In March, the yield curve, which is a line that plots the interest rates at a set point in time of bonds of varying maturities, did something unusual. So normally, short-term debt yields less than long-term debt. And this makes sense because when you buy longer-term debt, you're tying your money up for a longer period of time, and so you expect a higher yield to compensate you for this. But when short-term debt yields more than long-term debt, we call this a yield curve inversion. And it seems illogical at first that investors would be willing to accept a lower interest rate over a 10-year period than over a 3-month period. But this does happen from time to time, and it shows that investors are losing confidence in the economy's prospects. So to show you what happened toward the end of March, on March 22nd, the yield curve did invert. And on this day, you could buy a 3-month treasury bill and receive a yield of 2.45%. Or you could lock your money up for 10 years and receive a yield of 2.42%. So investors could earn more money by investing over a 3-month period of time than over a 10-year period of time. And this is important because the yield curve has a fairly accurate track record. An inverted yield curve has preceded the last 7 recessions, but it can send false positive at times. Now, the last time it did invert was in 2007, a few months before the Great Recession of 2008 began. But again, it's important to note that this has sent false signals before, and we want to see a yield curve inversion be more have more of a prolonged time period. It inverted for a few days. Currently, it's not inverted. It's very flat right now. But if we see this yield curve invert for a prolonged period of time, it increases the likelihood that a recession will occur. This does not mean that one is imminent. It just means that one is likely to occur. And usually, if you look historically, you have about a 12-month period of time. So when it does invert, historically speaking, a recession starts about 12 months after the yield curve inverts. So this is something we're watching closely for further developments. Currently, economic growth is slowing around the world, but many parts of the domestic economy remain very strong, such as the jobs market. So again, something we're watching. It did cause a bit of a sell-off around the end of March, but the market has picked up again. So we'll see how this plays out over the next few months. I wanted to touch quickly on the Brexit, as this was the focus of my last monthly update. The United Kingdom was due to leave the European Union on March 29, 2019, and unfortunately we were afforded no clarity on the matter, as the deadline was pushed down the road a few weeks. Where we stand on this is that UK lawmakers have 3 times rejected the divorce deal struck between Prime Minister Theresa May's government and the European Union. They voted on a set of alternatives, from leaving the bloc without a deal to holding a second referendum on Britain's membership in the European Union, but all alternative options were defeated as well. So the UK now faces a deadline of April 12, 2019 to present to the European Union with a new Brexit plan or crash out of the bloc that night. And as discussed on my last market commentary from a few weeks ago, if the UK crashes out of the European Union, that could be a shock to the financial markets. So this is something we are watching very closely as well. However, it's not in the UK's best interest to crash out of the European Union. And so we think that is an unlikely scenario, but it's still something that's on the table. So overall, just to recap the first quarter, risks to the downside do remain. We're keeping a close eye on the prospects of recession occurring maybe 12 to 18 months out, as well as the uncertainty stemming from the Brexit, and we will make changes to the portfolios as warranted. However, we've had a great start to the year. The majority of our models outperformed their blended benchmarks in the first quarter, and we've made up most of the losses that investors experienced in the fourth quarter because the markets have done so well so far year to date. So we thank you for your continued confidence, and please reach out to us with any questions